Welcome to Michigan Reimagined, presented by T.A. Forsberg and Waggoner Financial. And here's your host, Chris Buck.
So the world economy in early 2025 has been a roller coaster, to say the least. Here to discuss some macroeconomic trends, the news and commentary, and what it might mean to you are the members of the Waggoner team, founder and CEO Eric Waggoner, and investment associate Mark Hu. Welcome to the show, Eric and Mark.
Great to be here.
Great to be here, Chris.
All right. Well, for our listeners who don't know, what's the story behind Waggoner Financial, Waggoner Global Advisors? How did the two come about, and what's the philosophy and goal behind the two?
Right. So Waggoner Financial focuses on personalized financial advising, wealth management, financial planning, while Waggoner GA Global Advisor serve as our more of an investment research, sophisticated investment research and strategy hub. So it really kind of started when our firm, Waggoner Financial, had this commitment to give our client not just the best financial planning, but also high quality research, not just in the Midwest area, but nationwide, right? Global as well, right? So that's why we started hiring analysts from New York, from California. And as our investment research capabilities grew in the past few years, it really made sense to spin that out to a dedicated division. And that's how Waggoner Global Advisor was born.
Got it. Okay. So, and it seems like you would need to have a lens on all of those components in order to make the sound financial decisions for your exact client, correct?
Right.
Right. Okay. I'm seeing all the trends. And so with that said, so every quarter, Waggoner Global Advisors publishes a macroeconomic report.
Yes.
Is that right?
Right.
And so Q2 is hot off the presses, I think?
Yes. We're in the middle of that.
And so what do these reports tend to show? Where do you gather your information, and what is the deliverable?
Yes, so every quarter before the earnings season kickstart, we actually just finished pretty much at the end of the Q1 earnings season, we would publish a macroeconomic report. And that is mostly composed by Eric and led by Eric, and he delivers the presentation to our team and to some of the clients as well. That report breaks down key market trends, economic indicators, and global development that would impact our investment strategy. And these reports started initially as an internal tool to guide our research, but over time, we evolved into a more valuable resource that we sought initially. And we would love to share that with our clients and our partners. And the goal is very clear, is to offer clear, objective insights that cut through all the noise, and help people understand what's happening in the market right now and why it matters in their portfolio. And right. Eric might add some color on that.
Yeah, I think one of the key insights in the stock market is that stock prices in the short term don't have a lot to do with fundamentals. They have to do with like news and headlines. But in the long term, stock prices depend on nothing but fundamentals. So there's that, there's that dichotomy there. And so we want to try to take advantage of that. That's part of investing is to find mispricings in the market.
Yep. And
those mispricings usually come about by some sort of macroeconomic trend which is dominating the headlines. But maybe in the long run is not as important as people think it is in the short run.
Got it. Okay, that makes a lot of sense. So when we're going to talk a little bit about some of the Q2 maybe results or feedback or information that you've extrapolated, but what was the momentum kind of coming into Q2? Where was, say, Q4 of last year and Q1? Were there trends that when we report on Q2, that's not just a vacuum, right?
Right.
There was energy in certain areas that maybe either ramped up or died off.
Yes.
So can you kind of paint a picture as to where we were when we started Q2?
Oh yeah, we had a great 2 years coming into 2025, right? 2023, 2024, both 20 plus return years. And that's pretty rare.
Yes.
And everyone's very happy coming in. And S&P 500 and the NASDAQ keep hitting new highs at the beginning of 2025 in January and April. And we've seen in the Q1 of 2025, we've seen S&P 500's trailing 12 months price to earnings ratio shoot up to over 27 times. So for our listeners, a little more context, right? That's well above the long-term average of 19.6. So 27 in Q1 comparing to 19.6 in the long term. Now, of course, that's just one metric. And you can argue that we're in a different era. There was the AI boom and everything. The growth efficiency is just different. Everything's accelerated. But even so, signals like this are starting to flash, suggesting that the market might be running a little too hot. That's in Q1, right? And then as we're currently in Q2, as Q2 begun, the market were hit by a sudden jolt on April 2nd. A lot of the listeners sort of remember that, the Liberation Day, when President Trump announced sweeping global tariffs. And that is very unexpected, even for Wall Street, right? That shift sparked a spike in volatility, forcing investors to reassess risk, especially in a lot of the trade-sensitive sectors. Then, just a week later, a partial reversal, a series of tariff rollbacks, including a deal later with China, that helped the market rebound. So overall, I'd say Q1 and coming into Q2, this period is marked by sharp, event-driven volatility, driven largely by abrupt changes in the U.S. trade policy.
Is there worry that that's like manufactured? I mean, it seems like someone with that kind of power, and this, believe me, I do not want to go down this rabbit hole.
Sure.
But we're going to have a bunch of tariffs. The market tanks. Hey, you know what? Never mind. We're going to roll that back, or we're going to change it, and then it rebounds. I mean, couldn't people take advantage of that if you had some information that might be coming?
Actually, that's the entire game, is taking advantage of mispricings in the market. I mean, that's why we have a job. If there was an opportunity like that, there'd be nothing for us to do.
Right.
But size matters.
Yep.
And you talked a little bit about the Trump administration. What I like to say is that Republicans are red, Democrats are blue, but money is green. So we stay in between. So,
got it.
Coming into Q1, the market was extended. We'd had 2 great years, and it was exuberant.
Yep.
And when that happens, the market looks for excuses to pull back, to sell off. And so it really doesn't, was it the Trump tariffs? I mean, it would have been almost anything. I mean, just the market looks for ways to pop its own balloon when that happens. So that's what, and so it's important that you have the appropriate reaction to that, not any under or over reaction to that.
Right.
That's where all the opportunity is.
Got it. Okay. So where are we at now as the Q2 kind of wraps up? We, what's happening now? What does it mean? Why is it important? What are the headlines for Q2?
Right. So let's start with on the global front, right? So we're navigating a deeply complex and shifting global landscape, right? That a lot of talks is beyond the tariffs and global relations. At the center of it is the United States, of course, facing mounting vulnerabilities coming from both economically and militarily as well. So just to name a few, the national debt now exceeds 100% of the GDP. Interest payments are rising on those debt, and on the military side, the U.S. Navy has fallen behind China in ship count. And on top of that, the U.S. still depends on rivals like Russia and China for key energy and manufactured inputs. That's a growing concern in this new geopolitical era. And in response, U.S. policy and attitude have shifted dramatically, especially towards China under the Trump administration. So when Trump rolled back tariff, if you remember, on April 9th, he kept the 125% on China.
Yep.
Although a few weeks later he rolled it back, he dropped it to 30% after a deal with China. That's still higher than the universal 10%. That's 3 times higher.
Right.
That kind of shows his attitude to the world, that now we're viewing China as a serious trade rival.
Yeah, in East Lansing, we're familiar with the terms big brother, little brother.
Yes, we are.
And I think for a long time, China was our economic partner, but they've grown so much in the last 50 years that I think that Americans tend to think of China maybe as, to borrow that analogy, as little brother. But eventually, little brother isn't so little anymore.
Right.
And what's going on right now is the recognition that, when you're the big dog, you can do whatever you want unless there's another big dog. And China, understandably, doesn't necessarily want to take a back seat to us all the time. Right? And so where the opportunity is here is that competition is good. Competition forces people to be more on their P's and Q's, and the United States has to be more on their P's and Q's. It's exposing the fact that we're vulnerable in 2 areas. One of them is we're overextended with finance. Our debt to GDP is too high. We're losing control of the bond market because the Fed lowers interest rates, but the long-term rates go up. That means that people just aren't buying the bonds. They're not buying whatever we're selling.
Right.
And we're also overextended. I don't know if we're overextended, but we're certainly extended militarily. We're trying to defend 2 different oceans, and geopolitical events that are happening in the Middle East and Europe, and now we might have things going on elsewhere. So we have to we have to dot our I's and cross our T's, and we didn't have to do that so much in the past. But now that there are economic players and military players that are the same size as us or quickly becoming so, we just have to be better.
Right. So, and there's no short answer to this, but talk to me about the national debt. You just hear numbers and it's just staggering. And as a human on the planet who doesn't live in this every day, just like, whatever. I mean, put it on the tab. I mean, how do we work our way out of this? Is it important that we work our way out of this? What's the strategy? What can other countries like China do to us to hold us accountable for repayments? Or like, I don't even understand really how all that works, but it just kind of scares the crap out of me as a guy who tries to be really fiscally responsible. And I see that, and it just seems like it's the wrong thing to do from the country that we try to, profess to be the people doing it right.
I mean, big countries go broke. I mean, that's what happened to the USSR. I mean, and it's just like playing Monopoly. When you run out of money, you got to stand up and leave the game.
Right.
And it's, we should, keep that in mind when we put together our economic policies. I mean, it's not something that we can just kind of shove off to the side. I mean, our debt to GDP is over 100%. Our interest payments are staggering.
Right.
And a lot of that's happened. COVID put us in a position where we had to do some of that. So, okay, maybe we did have to do some of that. Maybe we did have to print a lot of money. Maybe we did have to explode the size of the assets on the Fed's balance sheet. But, when the party's over, you got to clean up.
Right.
You know? And that's what we need to do now.
Got it. Well, this is riveting, and I don't want to forget, so I want to give a shout out now to my friends at the Forsberg Real Estate Company. When it comes to creating the best living and working environments for the community, no one does it better than my friends at the Forsberg Real Estate Company. Brent Forsberg and his team create vibrant, holistic communities that inspire growth and encourage belonging. Focused on building stronger connections for people, the Forsberg Project is always in tune with balancing relationships to create the optimum human experience. Since the 1950s, Forsberg's been enhancing the qualities of life and the communities that they serve by following the principles of regenerative growth and aligning the resources and tools available. Reach out to my friends at Forsberg by calling 517-349-9330 or check out their website at lansingrealestate.com. So you talk about cleaning up after the party. What does that look like? How do we, I mean, and what's the penalty for not cleaning up and keeping our national debt where we are? I mean, where does that back up on us?
Right. So just a little more detail. Let's break this down a little bit more. So our debt, right? Eric talked a lot about the broader strategy and all that. So our America's debt clock just ticked past 36 trillion. And let's break it down.
Yeah.
It doesn't mean anything. It's just a number.
Right.
That's over 106,000 per person. Right, and that's not just the size of the debt that matters, it's the cost of the debt that matters. So about 28 trillion that needs to be refinanced at today's very much higher rates than previously, right? Nearly 5% comparing to previously 2%, and the consumers would know.
Right.
And that would push the annual interest payment, right, Eric mentioned, to 840 billion. And
annual interest.
Yes. And 1.3 trillion mid-year deficit already on the books. Lawmakers are proposing a 4 trillion debt ceiling hike. They're pushing up the ceiling again to extend the borrowings through 2026. So even with this projected savings and spending reforms that we hear in the past months, the math is very tight, and the stakes are very high. Otherwise, they're just going to keep extending the debt ceiling.
And so you talked about the penalty for having some policies like this. The penalty is that when the Fed lowered interest rates recently, what we saw is that the long end interest rates still went up. Now, that's a real problem when the Fed tries to lower the interest rates, but the long end goes up. Now, what that means is that, when you borrow long term, all your interest rates are still higher. So when the Fed lowered interest rates, the mortgage rates didn't come down. Houses are not more affordable. People can't afford houses.
Yeah.
So when you spend more than you have, you're going to get one of two things. Either inflation, which we've had, or pretty high interest rates, which makes it difficult to borrow, and it makes people, both of those things make it difficult to maneuver in society. Inflation makes gas cost more, makes food cost more. It's difficult for you to even move your body from one place to another. Interest rates make it so that your ideas have to be better before you can even pursue them. Right? Because that's the hurdle rate for how good your ideas have to be before you can even try something. So, and neither of those things are good for the more economically disadvantaged people in our society. Both of those things are very bad, right? So, so that's the penalty for us, not being able to keep this in check.
So if you're disadvantaged, what do you do?
Yeah, that's a great question. I would say you got to hunker down. Yeah. You got to you got to work harder. You got to be smarter. You got to, there's a lot to go around here.
Yeah.
Right. I mean, we have a lot of people making TikTok videos that would otherwise be productive. We have a lot of people that are playing video games that could otherwise be productive. I don't know that that's necessarily so good for them either. right? So, what if those people need to be focused on, being productive members of society and creating value.
Right. So what if you're maybe doing well financially and you're hearing this news, right? It's like, okay, I've got a portfolio out there. I got a good paying job. My family's pretty stable. I'm not disadvantaged. How do I use this information that I'm hearing from, Waggoner Global Advisors to either talk to Waggoner to help me do things differently or better, or my existing financial planner who maybe isn't Waggoner? What questions do I bring to them and just say, I heard some stuff that really kind of spooked me a little bit. What are we doing to make sure that I'm in the best possible position? What's your answer to that?
Yeah, I'd say first be calm through all the volatility, because we've been in a period that is like pretty much unprecedented volatility, event-driven volatility. Be calm first, and come to us, and we can talk about opportunities in the chaos, right? So magnitude matters when everything pulls back. Some things are supposed to probably have a very good reason, trade-sensitive areas, to pull back, and some things probably doesn't have a very good reason to pull back. And then for us, for our investment research team, our goal is to identify the opportunities in this chaos and what shouldn't be performing the way that everyone is overreacting.
Right. Okay. Skate to where the puck is going, not to where the puck is, I guess, right?
That's a great one. Every pearl of opportunity comes hidden inside of a clam of chaos. All
right.
And for most people, the less money that you have, the more efficient you have to be with it.
Right. Yep.
And it's not very efficient to do everything yourself. I just bought an EV. So I had somebody come to my house and install, 220, 240 volt.
Right.
I don't even know what that is. I could have done it myself.
Okay.
I could have. Right. And it may have taken me 2 years.
Right.
But that's not very efficient.
Correct.
And so I think that people need to, just because people work with money doesn't mean that they necessarily know how to,
Yep.
So I would say that if you have the less money you have, the more efficient you need to be with it. And so you probably need to be talking to people that know something about it, know how to handle it, know how it grows, know how it behaves, and at least get some pointers from them.
Right.
But don't do it yourself alone.
Yep. Okay. Maybe as maybe out of left field question, but it seemed like the energy prior to the Trump administration was all about kind of reshoring and bringing manufacturer back and stop going overseas. And we got exposed during COVID when supply chains broke down, and we had a bunch of 99.9% equipment, probably including your car, that was missing one small little chip that made it actually run. And so we need to not be beholden to some of these foreign countries, but bring some of those components back here to the States. Is that is it still happening? Is it prudent to be investing in manufacturing? Is America becoming more self-sufficient in a mission to become a better country with that issues? And is that even a good question? What do you guys think from Waggoner Global Advisors standpoint?
Oh yeah, this is definitely still happening, and a lot of things are still in the air. They don't have very specific policies detailing each sector or industry, like what to bring back, what not to bring back. Actually, the question would be what not to bring back, what to keep. What still globalization is a good thing on a lot of different levels, right? And so reshoring, nearshoring is gaining momentum in Q1 and coming into Q2. And you see a lot of companies doing that. They're bringing back production closer to home, and just based on manufacturing, a lot of these companies would benefit, like Caterpillar, like 3M, this heavy equipment and infrastructure, industrial innovation and exports. Like this type of company, no matter what you bring back, you're going to need to build more factories, and so these companies would benefit. And we really have to take a look at the detailed federal incentives and pro-manufacturing policies that comes with each sector, and so to determine where we want to be invested in. But just for example, like Taiwan Semiconductor Company, they are investing. They originally set the goal of investing $100 billion in Arizona. Mm-hmm. Now it's more than that. It's $165 billion, and they are also building an independent R&D lab in Arizona. So that is something I think that's key of reshoring. That's one of the keys of reshoring.
Right,
Semiconductors, chips, bring the most important things in the world back to U.S. soil.
So now the $100 billion that grew to $165 billion, yes. Do we know what that growth reason was? I mean, did they decide to build more, or is what they wanted to build more expensive because of maybe tariffs or or just the ability to get the lending and funding and interest rates and all those other things that kind of go into that? Because I know that there are a lot of projects that were kicking tires on moving to the States, and incentives were declared and costs were figured out. And now everyone's like, we got to hit pause because I can't have my project go up by 30% because it's not economically viable. So maybe I'm not going to reshore to the States and maybe retreat because now's the window, and the window is closing because of this uncertainty, and we're going to lose that momentum.
Right. So a lot of the businesses, probably that would be the case. But this is not the case for Taiwan Semiconductor.
Okay, good.
Because they are just probably one of the most important companies in the world, because they make all the chips. NVIDIA designs them, AMD designs them, but they make the chips.
Okay.
And from 100 billion, that is from, I think, the last year's earnings call, but the most recent earnings call, the number grew to 165. That is a 65% increase. Not a small, just a budget.
It's not a line item glitch.
Right.
Yeah.
Yes. So they are the new news. The new news on this is they're building an independent research and development lab. And they're going to hire more people, and that is very important to the U.S. government as well. One of the reasons of reshoring is to boost the employment rate as well.
Yep.
Right. So
high-paying jobs.
Yes.
Yep. Employment factors. Makes a lot of sense. Talking about raising money, let's talk about our folks at Michigan Rise. This episode is brought to you by the Michigan Rise Pre-Seed Fund, providing early-stage funding to Michigan-based startups. Since 2020, Michigan Rise has helped high-tech, high-growth startup companies achieve commercial and technical milestones through capital formation strategies, talent development, and customer acquisition tactics. With financing options for every stage of the entrepreneurial journey, Michigan Rise significantly increases the impact of new ideas and research. Visit www.michiganrise.com to discover how Michigan Rise can help you fuel your startup's growth. Michigan Rise is supported by the Michigan Economic Development Corporation and the Michigan State University Research Foundation. So that's all good stuff. I'm glad the reshoring's happening. I think bringing manufacturing jobs and having the U.S. be self-reliant, having better high-paying jobs, and can help us dig ourselves out of whatever holes we put ourselves into. But if we want to flip it to the future, what did Q2 teach us? What is the momentum teaching us? What do we think Q3, Q4, and beyond is looking like? What are the trends that are happening right now shaping our near future?
I wanted to add a little bit on that last discussion. During COVID, we ran out of everything, right? We ran out of semiconductors. We ran out of dark chocolate. We ran out of baby food, right? And so that's the kind of thing that happened. I mean, just our global supply chains were shut down. And that's just what happens when people don't go to work. Because when people don't go to work, nothing gets made. Right? And so, but this whole reshoring effort, I think that a lot of people are really underestimating the momentum behind the reshoring effort. We have some military sensitivities, and we can't manufacture things in the United States the way that we used to. We are absolutely getting out-manufactured. So I can tell you I play chess.
Okay.
And you can lose to anybody in chess. All you have to do, it doesn't matter how good you are, all you have to do is underestimate your opponent. They can be terrible, but if you think they're worse than that, they will still beat you. And so what we have to do is be really honest with ourselves about the competition that we face, our manufacturing capabilities, and the United States is stretched thin militarily and also financially. So these reshoring, why that's important is because these reshoring efforts are going to happen. Because they're really striking at the heart of something that's very sensitive to us if you actually know what's happening. So it's a mistake to think that some of these ideas will just blow over. They won't blow over.
Right.
But you asked about Q3 and Q4.
Yes.
The good news is competition is good.
Yes.
We are all going to, us and our competitors are all going to emerge. We're going to create a lot of value. We're going to operate smarter. We're going to be faster, leaner, meaner, them and us. And that is very good for the stock market.
Okay. All right. How so?
Yeah. So, for example, the AI infrastructure and application part that we just touched on, and we have a lot of competition in that, right? Massive investment. This is just we're pretty much at the start of it only.
Yep.
Massive investments in AI infrastructure are transforming industries all over the place, in healthcare, in finance, in manufacturing. And the US tech giants are leading it, right? NVIDIA is leading in AI chipsets and networking. Their earnings just was out last week, and their revenue grew staggering 69% to $44 billion on a $26 billion base from the same quarter last year. Right, and then they regained the title for the largest company in the world passing Apple and Microsoft, right? And then you have the other ones that the Google, Alphabet's Google, Amazon's AWS, Microsoft powering cloud-based AI services, and Meta doing a little bit of both. They have their Llama, and they're probably one of the best players on the application side as well. They use their AI to sharpen their ads targeting and revenue efficiency, right?
Okay.
It's all about efficiency with AI. And then with the competition outside of the US, the EU is stepping up, trying to close the gap in AI innovation. And we all know that China is very tight in the race as well. So the outlook is that moving forward to Q3, Q4, and even beyond, that AI would boost profitability and productivity. And we will see how that goes.
Yeah, so when Europe tries to close the gap, they got to spend money. When they spend money, they got to buy stuff. When they buy stuff, they got to buy things like semiconductors and applications and cables that connect those semiconductors and servers. And so we take our clients' money and we invest in those things.
Right on. Okay. True. Right. It's the gaps and the things other people aren't thinking about is where the strategy comes into.
Oh, yeah.
That makes a lot of sense to me. With AI and safeguards and being in the Wild West out there, where do things stand with cybersecurity? It feels like AI has kind of trumped cybersecurity in the headlines. Like it was really like a year and a half ago. It seemed like I had people wanting to come on the show to talk about cybersecurity because it's not a matter of if but when.
Yes.
And nobody's paying enough attention to this, and it seems like that's kind of faded into the background. Is that still an industry people are paying a lot of attention to?
Very much so, because when the stock market pulled back in April, there's one sector that did not pull back as much, and that's cybersecurity. With the Zscalers, Palo Alto, CrowdStrike, they held up pretty well. That's because they are essential to whatever you guys are going to build with this AI application. So on the very basis foundation, expanding digital networks means bigger cyber risk footprint.
Okay.
Right? Cybersecurity is now a non-negotiable for business to continue and for them to follow compliance as well. So leading firms like CrowdStrike specializes in endpoint protection. Zscaler specializes in zero trust, and Fortinet, Palo Alto specializes in next generation firewall. These companies are essential to the operations of whatever you're going to build out there with AI and all that.
Okay.
And this sector is seeing continued double-digit growth. It's not going to be astronomical. It's not going to be 70%.
Yep.
It's not going to be 40% even. But it will see continued, maybe 20%, or the smaller firms, the younger growth firms, 30%, double-digit growth, and they have a very long growth runway ahead of them as well.
Got it. Okay.
Yeah, cybersecurity is one of my favorite sectors. It's the gift that keeps on giving. It's growing fast and it's defensive.
Okay.
So, I mean, what's not to like about that? Yes, the industry may slow down a little bit. It may not grow at 70%, but one of our biggest holdings is a cybersecurity company, and it's grown 65% year to date, and it's June. We're in June of 2025, so it's got a lot of room to grow. Maybe the entire sector won't grow that fast, but we invest in one company, they get big. We take the money, we invest in another company that's smaller, they get big. We invest in another company that's smaller, they get big. So that's the game. Yeah.
Got it. Okay. So we're starting to get up against the clock a little bit, so I want to make sure we get the biggest bullet points out there. So what are the risks? Like what in the near future are mistakes that financial planners or people playing in the market can make? What might not they be looking, correctly at?
Right. So in terms of the market, what we should be looking out for on the macro end, like Eric said, weakness in the treasury market. That's a big one, right? The treasury market is showing some signs of strain. With recent sell-offs pushing the yield higher, this shift can potentially rise borrowing cost and complicate government financing, and especially with this debt level that is remaining this elevated. Now, a second point would be in the market, this is more consumer related, advertising spending slowing down. Right, so we have to watch out for advertising spending cooling as companies grow more cautious in this tough, still high rate, and with the tariffs coming, if they cut back on their advertising spending, that may weigh on revenues on giants like Meta that depends on these revenues, and especially with notable drops from performance-driven ad traffic from China as well. So we want to keep an eye on that as well.
One of the mistakes I see is, people letting their political biases get too much in the way of their investment decisions. So whether you love Trump or hate Trump, if you spill a glass of water, the water's going to go where it's going. It really just doesn't care about your opinions on politics.
Right, okay.
And money flows like water. It's going to go where it's treated best, where it grows best, where it can be put to its highest and best use. So if you are too much in favor of some political policy, or not enough in favor of it, the money is not going to care about that. So I think it's really important for people to just keep a calm demeanor and invest based on how the money is going to behave,
right,
rather than what you think some policy which could be overturned tomorrow is going to do, whether you think it's a good policy or a bad policy.
Right. That resonates. I can follow that. And I'll tell you, it's a polarizing time. It is hard for people to keep that in their back pocket, right, depending on how they feel. But financially, that's why you trust agnostics like yourselves who are saying, listen, we're going to go where the green is and help you be secure, and you can go have your political concerns in other forums, but we're not going to put your money where your head is. Makes a lot of sense to me. So, as we kind of start buttoning this up, let me just ask you, what are some final thoughts that you might have as we close up this conversation? Because I'll tell you, while I enjoy the conversation, because we prepared for it a little bit, and I knew a little bit about where you were probably going, I don't like to think about all this stuff. I don't have the bandwidth in my day-to-day life. I'd rather spend time with my kids and my family and my endeavors to go do this, and trust someone else to handle this heady type of stuff.
Right.
So I guess I would just challenge, and it's kind of a shameless plug, whoever your financial planner is, you need to confirm that they're talking like this, because you can't just say we're going to put it in IBM and go night-night on it and just hope that gets you the returns you're looking for, that you're going to hit your goals with that. So without teeing you up too much, what are your final thoughts as we close up?
I think that one thing that people don't do enough of is make sure that their financial planning is exciting.
Okay.
Because people have better outcomes when they're more engaged, and they're more engaged if they're having more fun. So sometimes I'll say that to our clients. I'll say, maybe we're going to outperform the market, maybe we're not, but it's going to be more fun either way. Okay. And that's a little tongue-in-cheek, but if the clients are more engaged and they're just more invested in the process, just from an attention standpoint,
yep,
they always do better.
Got it.
And so I would say that make sure that when you meet with your financial advisor, whoever it is, that you have an exciting plan, you're amped up about it, and you're just excited for the future. You're even excited to have that meeting.
Right on. Okay. Any final thoughts from you, Mark?
Yeah, I think it's just basically what Eric's saying, right? A lot of exciting things happening in everyone's lives, and basically, if you want to offload some of the investment stuff to us or another sophisticated investor just as sophisticated as us, you are definitely welcome to do so, and we will play the game for you.
Right on. Well, how can people learn more about Waggoner, the Waggoner team, Waggoner Financial, Waggoner Global Advisors? If they wanted to learn more from you and hear about your other offerings, how would they get in touch with you?
Well, we have a website. It's www.waggoner-financial.com. So that's WAGGONER, so 2G, financial.com. And of course, we send out some market updates every morning. It's called, we have a market newsletter called On the Money.
Right.
And Mark and the other members of the investment team help put that together every morning. So every morning in your inbox, you can receive 5 bullet points of what's going on today that can keep you engaged. And you'll just, it's a quick way for people to stay, up to speed with what's happening.
Fantastic. Well, I appreciate you both being here. We've had Mark Hu and we've had Eric Waggoner from the Waggoner Global Advisors and the Waggoner team overall. Really appreciate you joining me here today, and thanks for all this information you shared. It's fascinating. And I do want to give a final shout out to all my loyal sponsors. We do have Forsberg Real Estate, Triterra Environmental, Good Marketing, Keller Williams Advantage and Team, Michigan Rise, the attorneys of Foster Swift, and Waggoner Financial. These are fantastic people that are worth the call. And if you found the show as a one-off, I want to remind you to follow and subscribe to Michigan Reimagined on YouTube, Facebook, Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, and pretty much anywhere you find your podcasts. This is Chris Buck signing off for Michigan Reimagined.